and you have like 70%, 80% of the workflows already in-house in there. And the very least you can do is say, yeah, sure, we can try. Or like, yeah, I mean, we can start right away, like see where we're at in 2 weeks, whether you need a change or an upgrade or something or not. Yeah, that's just one of the agency powers that I found very underappreciated nowadays.
Yeah, I mean, it's kind of like one of those things where you learn how to do something and you get quite good at it, and then you mention to people that you know how to do it, and then they're like, "Hey, could we pay you to do that for us?" That's the model. And so it's like, you saying that's going to go away? I don't think so. So yeah, I think that's a good point.
Hey everyone, I'm really pleased to have Dominic Wells here with me, the founder and CEO of Onfolio Holdings, which is also listed on Nasdaq, which is another topic that we're going to review here. I'm really, really thrilled to have Dom here. We've been chatting for probably over the past year or so, maybe a year and a half, and he gladly accepted my invite to chat some of the latest innovations in Onfolio, some of the latest deals available in the SPV. Why is he spending so much time on social, and lots of other interesting topics from someone who's actually the CEO of a Nasdaq-listed company. So thanks once again for accepting the invite, Dom. How are you doing today?
Yeah, I'm doing great, thanks. Looking forward to it. So yeah.
I love all the kind of cross-Atlantic, cross-Pacific type of conversations and kind of getting the scheduling ready. So really appreciate all the flexibility as well, being based in Europe and Asia accordingly. So the first thing I want to kind of bring up as context is I've been following Onfolio for a while, especially after the kind of the drop of the market and kind of missing on some of the opportunities in kind of investing, in kind of stock market going down last year. And Onfolio was something that is kind of a business that's consistently investing in profitable companies. So let's kind of start with this one first. So tell us what Onfolio is and why is it such a lucrative opportunity?
Yeah, well, we are a serial acquirer of profitable online businesses. So what that means is we buy online agencies, we buy some small e-commerce businesses, a couple of marketplaces. We used to buy a lot of content, but luckily we moved away from that model about 3 years ago. And we operate in a holding company model where the idea is to buy the businesses, run them somewhat decentralized, but also acting kind of like a board of advisors for the companies and then holding them long term. So we're not doing the kind of private equity fund flipping model. We're also publicly traded, which is kind of part of what you were talking about. We've been listed on Nasdaq since late August 2022. And so I can't really speak, I don't think I'm really allowed to speak about how lucrative it is to buy our shares. But in terms of what we're doing and why we think what we're doing is lucrative, is there's kind of with the size of businesses that we're buying, it's kind of a fragmented industry where there are a lot of, there aren't like 2 or 3 players that dominate every industry. So in, for example, B2B services, there's hundreds, maybe even thousands of different businesses that deliver similar services. And then there's same for some of the software that we've been involved with, same for e-commerce and the online courses. And so as a result, it creates these opportunities where, first of all, you can start consolidating, but second of all, the acquisition multiples for these businesses are not that high. So we've paid something like 3, on average, maybe just over 3x this year. I think we paid 3 at the start of the year. We paid 2.5 on one in June, and we paid just over 3 for our last acquisition that we announced about a week ago. And so that in itself is lucrative, because if you buy a business at 3x or 4x even, and you maintain the profit level, which is no small feat, that's, I think, where a lot of people struggle. You're going to get 25, maybe even 30% returns just by kind of acquiring that business and deploying the capital that way. So that's kind of what we're trying to do, is how can we do this at scale? Rather than trying to scale one company, we're trying to scale our company through buying lots of smaller scale businesses. So yeah, that's the kind of that's the thesis there.
And again, I love the process, and I've been sitting on both sides of the fence for over 15 years now. So I have about 20 individual angel investments. I'm also diversifying the stock market and whatnot. I run several businesses, and kind of my main kind of the highest revenue business that I run is the agency. And it always sucks when I see that multiples are so low compared to SaaS. So on the one hand, I really wish that exit opportunities were more lucrative for agency owners. On the other hand, probably 5 or 6 years ago, I just accepted that the agency is a cash cow, and reinvesting the profits in the agency is better utilized in other ventures that are generating recurring revenue and are kind of creating different revenue streams or kind of different lines of businesses that are cross-selling and kind of amplifying the value for one another. So also full disclosure, I also joined your SPV, which is kind of another business that I'm going to ask you to touch on because I know that you're still raising, and I just doubled down on my investment a couple of weeks ago. So kind of with that in mind, I believe it's a great opportunity to kind of just join and be able to create a network of other businesses across the board. So again, for some extra context, I've also been working with Flippa kind of as an ambassador. I've acquired 30 or 40 small businesses through Flippa over the years, and they weren't really that high level, just from a sheer financial fiscal standpoint, as compared to some of the agencies that are in Onfolio's portfolio that I have an opportunity to kind of join and kind of make an impact with. And additionally, I know that you're kind of diversifying into different agencies, however, ones that are able to complement one another, which is creating a higher value point by kind of a micro empire of different businesses cross-linking to one another and being able to upsell and kind of create a broader, stronger value proposition for the bit. So let's expand on this part of the growth journey itself.
Yeah, there's a lot there, but it's interesting because one great thing about agencies that nobody talks about, and maybe even some people talk about it actually as a negative, is that agencies are very much people businesses. And so what makes them challenging to acquire is, a software business that has recurring revenue. Usually it's growing pretty fast, and you just spend money to make money because you do advertising and, you hire business development and so on. And with agencies, it's a lot more challenging, which is why the multiples are lower. But the great thing about agencies is because they focus on people, what you get every time you acquire an agency is you kind of get this untapped well of adaptable, business savvy, pretty resourceful people. And when you start acquiring multiple groups like that, then they can do a lot more under one umbrella than they can as like separate entities. And so that might mean companies that have similar but not exact offerings, because maybe you're not going to get the benefit if you just acquire like 10 of the same company. But if you acquire companies where maybe they're all serving the same clients but in a slightly different way with a slightly different thing that they're doing, like it could be a media buyer and then you acquire an email marketing agency. Or it could be maybe they do similar things, but they do them to different types of customers. So there's kind of different ways of doing it. But every time we've acquired a business I'd probably say in the last year, we've realized like, wow, we've just acquired a really good team of people who actually know more than us about agencies. And, they have some other things that they know less about, and we're able to complement them that way. And then you acquire another one and you think, wow, now we've got two of those teams, and those two teams meet each other and they're like, oh, wow, like now we can do even more things together. So then you acquire a third one and a fourth one, and suddenly it creates this flywheel, which is it's kind of difficult to underwrite, I guess. It's difficult there's a lot of intangibles, but basically by increasing your talent density, you get a lot of benefits that probably don't show up in due diligence or on a spreadsheet or anything. So that's been the biggest surprise for us, kind of like happy surprise, is we know, okay, we have this business which serves this clientele and they're missing this service. So Eastern Standard, who we just acquired last week, they have a lot of opportunity to offer SEO to their current customer base, but they don't offer SEO. They've thought, okay, should we build an SEO team? Should we outsource to people? We'll deal with that problem later. So they just didn't offer it. And now they're looking at Revenue Zen, which is an SEO agency in our portfolio, saying like, hey, let's get on the phone with them. And so Eastern Standard, hopefully, they haven't done it yet, so it's only been a week, but the idea is they'll put their heads together with Revenue Zen and be like, should we white label Revenue Zen? Should we contract stuff out, like a subcontract to Revenue Zen, or shall we kind of hire Revenue Zen to help us build an in-house team? And it will probably be one and then the other and then the other over time. And so that's a really basic example where you're like, yeah, okay, obviously 1 + 1 is 2.5 or even 3 or 4. But what we didn't realize is just having those minds and those brains all under like that one umbrella brings a lot of other kind of like troubleshooting and knowledge sharing that benefits everybody. And so we're learning more about agencies with every acquisition we do, which is then benefiting the agencies that we acquire, but it's also benefiting the agencies that we've already acquired because that knowledge is filtering down throughout the whole portfolio. So what many people view as the negative aspect of acquiring agencies, which is the kind of messy people element, is actually probably the benefit is one of the advantages, the way we...
From an agency standpoint here, and I'm also going to ask you about the kind of agency size and what you're looking into, because I also know we have other agency owners listening into, but you're definitely, I want to double click on the messy part about agencies is people, because dealing with people is hard. And that's why AI is growing so much right now, because it just gives an opportunity to kind of Fortune 500 and essentially every single business on the planet to automate more and deal with fewer people. And people are a problem. And, however, inhumane or kind of Republican that may sound, it actually is really tricky to deal with people. But in a nutshell, one of the things I'm super grateful for kind of as an agency owner is we are going through ups and downs. We are surviving like 2 or 3 recessions, depending on kind of how you count them, by just diversifying what we offer and repackaging and positioning ourselves differently, which is something that you simply cannot afford to do with a SaaS, right? If you are, for example, a lead generation SaaS, you can't magically become an R&D development machine. Or if you are, high tech product for, observation solution for DevOps, something, infrastructure, you can't magically start generating marketing leads or the other way around, right? So in terms of SaaS, you're fairly limited, very niche, narrow ICP, very specific, unique selling proposition. And the reality is that depending on how the market goes, ups and downs, companies are investing in R&D or in operations or in sales. Like these are the 3 main kind of divisions. And if you happen to be in the wrong vertical at the wrong time, it just gets pretty messy. Like right now, I don't want to be a recruitment firm. It's not the best time to be, selling headhunting services, simply because hiring is on the low and it's just hard to find people and companies are more picky. It's not a great business. But if you're a service business and not an HR software product, it's so much easier to start saying, hey, we used to be selling full-timers, but right now we can actually, work with 10 of them and create outsourced freelance services and charge a commission almost like a marketplace, for example, right? And just kind of pivot into a completely different venture, just relying on your core value proposition, which is people and access to a database of individuals that you can do something with. So it's just an interesting train of thought if you think of the power of agencies and how, even if now it looks like a great opportunity to join, Onfolio's SPV, for example, or just invest in Onfolio on the market, then the opportunity to work with an agency also allows agencies to be agile and flexible and to adjust to different times. Like, what's to stop any of these businesses to integrate AI heavily, or if the metaverse, suddenly becomes more lucrative, start offering digital marketing for metaverse customers, similar to Second Life or The Sims back in the day, and just unlocking so many other opportunities in the future.
Yeah, I think I say a lot of the time when we're trying to buy a business, we want to buy a business that can pivot if it has to. And I've had conversations with shareholders who have said, well, isn't it best to buy a business that doesn't need to pivot? And it's kind of like, well, yeah, obviously that is better, but the internet hasn't been around long enough to even know if any business exists that doesn't need to pivot. Like even if you look at something like HubSpot, they've grown very much on an S curve, and they've iterated and they've made acquisitions and they've bought along things along the way. It's not just like you have a software company that creates a product and then it gets recurring revenue and it's happy days. And you look at, say, Jasper AI, for example, which was, I think it was the fastest unicorn in history. And now I don't even know if they have any revenue because ChatGPT came out and basically exposed them as an OpenAI wrapper. And so the point is, like what you're saying, yeah, it's difficult for software businesses to pivot. And I don't want to, I'm not here to criticize software businesses because at the end of the day, there's a lot of great businesses.
Yeah, absolutely.
But I read this white paper by NZS Capital about, I think, 2 years ago, and it was called Complexity Investing. And the basic idea was that a lot of systems are complex, so you have to have adaptability. And the two things that stood out for me were the ideal business is kind of diversified and can survive in various different scenarios, but it also has optionality so that it can take advantage of opportunities that come up in front of it. And so I think an agency is a really good example of that, because let's say it's an SEO agency. So in 2014, what an SEO agency did versus what they do 10 years later today, fundamentally, sure, they're trying to rank their clients at the top of the search engines. But the strategies and the tactics they've used that 10 years ago versus now are completely different. Maybe back then they would have just used PBNs and some social bookmarks, a little bit of on-page tweaks, and then job done. Whereas now they have to do a lot more or things a lot differently. But the point is, an SEO agency can survive because it just says, okay, that thing doesn't work anymore, let's offer this. And maybe people say, well, is SEO going to be dead in 10 years? I don't think it will be, but let's say it is. Well, that SEO agency, the good ones, will just become marketing agencies, or they'll just become, they'll just pivot into different models. I mean, even Ahrefs is kind of moving away from trying to be an SEO tool to being a more like full suite marketing tool. And yeah, in an ideal world, an agency doesn't do that, but a good agency is able to. And when you look at AI as well, people think, okay, how's AI going to impact agencies? Obviously, people who work for OpenAI say a lot of agencies won't exist anymore, or you won't need agencies because AI is great. But I think when it comes to running an agency, you're always trying to improve efficiency as well as, like sales and so on. And there's three ways to improve efficiency. One is by automation, one is by technology, and one is by, just upskilling the workforce. And so what AI has done is allowed for that kind of technology section to improve, but it hasn't eliminated the need for everything else. And so, for example, RevenueZen, I think about 2 years ago or maybe 18 months ago, but basically before we acquired them, one account manager was managing about $10,000 of revenue. So each they had, say, 3 or 4 account managers, and each one could manage $10,000 a month in revenue. And they said to their team, okay, we want to double that. And the team would say, well, there's no way we can manage more revenue. We obviously, without just doubling the prices of all the clients, but we can't manage more revenue because we're already busy. And so now I think one account manager is managing $45,000 in revenue. So they actually doubled it twice. And they did that through improving systems, using technology, and whatever the other thing was, basically upskilling the workforce. And so AI basically will just augment those efforts, and they're already using AI in some ways. But it's not like, oh, we fired some of our team and we're just using robots instead now. In fact, I think one thing AI really helps with is improving the happiness of your team. And so when you think about how messy the people elements of agencies are, a lot of that's because a lot of agencies work from home, and you can work for an agency for, say, 6 months before you go crazy. And what AI has done is basically made it so that a lot of the boring, monotonous, like repetitive tasks are now done automatically. So you can focus on things like being creative or speaking to clients, or like the things that really drive the lever. So I've kind of gone off in a long tangent here, but I think the point of the message is, I don't think it's necessarily a bad thing that an online business has certain sort of traits that mean it always has to be like kind of evolving and changing. I actually think that, really the internet's only been around 30 30 years, but the internet 30 years ago was very different from the internet today. So even then, it's constantly moving, and so some of the best acquisitions are going to be ones that are also like constantly able to move. So yeah, that's kind of my point there.
Yeah, and in addition to kind of what you said about AI and agencies, the other factor, and I think it's kind of worth noting, is I'm seeing more and more analysts now discussing the potential, and that's kind of more or less a conspiracy theory, but we live in very interesting times, especially in the 2020s, between pandemics and recessions and wars and like everything else going on. But kind of one of the theories is in the next 2 to 6 years, we're going to observe another bubble burst similar to the dot-com bubble in the AI space. And that's primarily due to all of the kind of pointing VC capital to the largest AI players and pouring hundreds of billions of dollars towards each of the kind of big players, be it OpenAI or Anthropic or Google. So just pumping and kind of trying to stay ahead of the game. So ultimately, what's going to happen is first off, the market is going to oversaturate the kind of the net new revenue or kind of net new user growth rather, because revenue is pretty low, is going to kind of flatline. And we're probably going to work with one player, and everyone else is going to use Mistral or Llama or something else, and they're just going to undercut, so that kind of the race to the bottom is going to normalize pricing, and then the kind of revenue opportunities for the largest players are going to kind of collapse and implode even. But regardless of kind of whether that's going to happen or what kind of period of time or kind of who's going to be a winner, what makes an agency different is an agency does not necessarily care whether they're using ChatGPT or Claude or Gemini or Grok or something else, right? Whoever wins in the AI games, it's not, go big or go home. It's more about we are monitoring all possible opportunities and channels and tools and scripts and kind of what prompt engineering suits each of the systems, and we're just using whomever is best. So it's pretty impartial in a way. You're not betting everything on one horse, and it's a lot more resilient over time, which I think is kind of one of the strongest points for diversification for everyone who's either starting an agency, investing in an agency, buying an agency, or having anything to do with an agency versus high revenue multiple SaaS, for example, or subscription business.
Yeah. At the end of the day, like even if everything that agencies do today is completely replaced by AI, I think agencies will just evolve. And so it's not like someone's going to say, let's say they're using an agency to do their Facebook ads, and the agency's coming up with the creative and then creating the creative and then managing the ads. If we reach a point where AI can do all of that, and we probably will, I don't think someone will say, I don't need agencies anymore. They'll just say, cool, I'm going to hire an agency that can manage all that for me. So it kind of just like, it'll just mean that agencies just do different work. So as long as you're like monitoring it and staying on top of it, then yeah, agencies are just going to benefit from the sort of AI arms race, because like you say, they're kind of agnostic to which particular AI works. And I had a call with someone about a month ago who's building a software tool that kind of allows you to split test all the different AI models. So yeah, it could be like, okay, here's the thing you want to do. If you run it on Llama or Claude or OpenAI or the various ones, here's what the output is. So you can be like, oh look, this one is good enough, but it's actually way cheaper. Or this one is the best, but it's a little bit more expensive, so I'm going to use that one. So agencies will just be like, okay, cool, we'll just, they'll be the people who are managing those things for people, and they'll probably be charging a markup for it. So, that's where the profit will continue to come.
And the last part before we kind of close the agency chapter per se is in terms of diversification. What I can share again for the people running agencies or kind of having an agency in their portfolio in my network who may be listening is we are, especially over the past couple of years since the B2B layoffs and the Fed interest rates bumps and all that, what the services we're offering over the past 6 months, half of them did not even exist a year and a half ago. And that's due to the fact that an agency is running a lot of the operations internally because it's just the agency life, right? You may be offering, let's say, design services or SEO services, but you're probably running your own PPC ads, or you're doing your own WordPress website development, or you're doing your own SEO or so. For the most, you may be working with freelancers or consultants or so, but you do most of the heavy lifting yourself just because you have agency talent, and that's kind of the nature and the breed of the business. So we've been doing things for years that lacked any demand whatsoever. And kind of one day, just five of our clients called us and say, hey, like we're desperate for SEO. Can you recommend someone? We're like, but we have a department that's been working for a decade. We just have like two full-time people and we haven't expanded that. So yeah, sure. So we had to hire 3 more people the next 2 months, right? That happened with this happened with HubSpot, just building new workflows when our B2B and Quanzu came up. And just randomly, when you're an agency and you have a portfolio of clients, it's not uncommon, especially in turbulent times, to hear 5 clients asking for the same thing over the course of 2 weeks. And you have like 70%, 80% of the workflows already in-house in there. And the very least you can do is say, yeah, sure, we can try. Or like, yeah, I mean, we can start right away, like see where we're at in 2 weeks, whether you need a change or an upgrade or something or not. Yeah, that's just one of the agency powers that I found very underappreciated nowadays.
Yeah, I mean, it's kind of like one of those things where you learn how to do something and you get quite good at it. And then you mention to people that you know how to do it. And then they're like, hey, could we pay you to do that for us? That's the model. And so it's like, you saying that's going to go away? I don't think so. So yeah, I think that's a good point.
Let's chat about the SPV. So tell me how you came with the idea, because again, Onfolio is Nasdaq listed and there are opportunities to kind of grow and invest there as well. And there's the SPV as well. What kind of sparked the idea and how is that working?
Just different attempts to create a compelling offer for investors. So after we went public, we didn't want to issue more equity to raise money to acquire more businesses, because generally we want to be as non-dilutive as possible. So sure, sometimes we'll issue stock options to employees and stuff, but aside from that, we don't really ever want to issue more common stock. And so we were looking at a lot of debt options. But we're kind of a small company. We're buying online businesses. There isn't a lot of debt available to us, or it's debt that we don't want to take on because it's highly toxic, comes with a lot of risk. And so we also have a preferred share, and our preferred share is actually going to be listed on the US exchange, probably OTCQB in the coming weeks. So that may prove to be a better source of capital for us in the future. But the preferred share is essentially just like it's a straight 12% dividend. So if somebody invests 100K, we pay them 12K a year. What we found was there was a lot of people who were these kind of fixed income investors who like the idea of a 12% coupon, but they didn't really understand what Onfolio did. They didn't really understand sort of online business and so on. And maybe they were nervous about Onfolio's overheads, because being a publicly traded company, we have a lot of expenses. And so we would say, hey, we buy online businesses. And then people would look at our consolidated financials and be like, what do you mean you buy profitable businesses? These, like, your revenue is really high, your net margins don't make sense. So we had people, though, who said, hey, if you find a good deal, I'll invest in that deal with you, so that I'm just exposed to your expertise and your deal flow, and I get the cash flow from that business, but I don't have to worry about like your sort of consolidated overheads and stuff like that. And I actually thought, well, that works great because that's better for us as well. And so that was one thing. And so we kind of toyed with the idea of, okay, how should we like raise a fund, or should we acquire businesses with co-investors where they put in the capital and we own a certain percentage of it and stuff. And we couldn't quite make it seem worth our while, where like we'd have to raise a lot of money and we wouldn't necessarily get that much of the profit ourselves. But then throughout 2023, we noticed a lot of agency owners were selling for lower multiples and for less cash up front. So previously you might need like say 70% cash up front, 80%. And you might need to pay 4.5 times EBITDA. Whereas now we were having conversations with founders who were kind of just happy to have a buyer. And so we could give them 30% cash up front or 40%, and then give them our preferred share, and then maybe 20 or 30% is a seller note as well. And so what that allowed us to do was basically say, okay, we can bring in co-investors who kind of pay for the cash up front portion of the deal, and they'll own, say, 30% of the business or however much cash they put in. We'll own the other 70% because of the kind of debt, the seller note, the preferred share that we've issued. So it's very lucrative for Onfolio, makes sense for our shareholders, but it's also great for the investors who've come in and done the cash portion. And then we looked around and we saw, well, there's a ton of opportunity, because it's not just a one-off deal. There's like 5, 6, 7 deals in our pipeline right now that fit this criteria. So let's raise an SPV so that investors are diversified. And so that's kind of the long story, which hopefully didn't bore everybody listening. But basically what it means is now we have this opportunity where investors can invest in the SPV, which is just like a Delaware LLC. And then that SPV comes into deals with us and puts in the majority of the cash. And in exchange, investors will get minority ownership in, say, 5 agencies or 6 agencies, or just as long as the SPV still has money and is participating in deals, that number will grow. And they're investing at a multiple of anywhere from 3 to 4x. So if we're just maintaining the cash flows of the agencies, and that's a challenge. Sometimes they'll go down, but sometimes they'll go up. So over a diversified portfolio, it should balance out, and we're expecting that there will be some growth. And the first couple of acquisitions we've made have grown. But what it means is investors should probably get something like 20 to, let's say, 25% cash returns diversified across a portfolio of 4 or 5 businesses. And then I thought, well, the only negative here is we're never planning to sell these businesses because we own, say, 70%. We don't want to sell them. We want to hold them forever. And that's fine if our investors also want to hold them forever. But what if they want to sell? So, we're not planning on building up to an exit. So we put this mechanism in where basically once a year investors can say to us, hey, I want to cash out all of my holdings or half of my holdings or whatever. And we twice a year, we will have calculated like how much the holding is worth, like has it grown, for example. And so then either, let's say there's another investor on the sideline who wants to come in, or we'll just buy them out ourselves. But then an investor can cash out. But in the meantime, while they're holding, then they'll get shares of dividends as well. Because again, if we own 70% and they own 30%, we obviously want to dividend the profits up to Onfolio Holdings, the parent company. So every time, every dollar that goes up to the parent company, in this example, 70% would go to us, and then 30% would go to the SPV. So again, I feel like for people listening or watching, this might be challenging to wrap your heads around. So basically, to summarize, it's like you're co-investing in deals with us, you're getting diversified, you have some liquidity because you can exit once a year, you'll get quarterly profit share dividends, you're investing in a passive way where the returns should be pretty lucrative because like the prices that we're paying. And so it's kind of like, well, what's not to like? But, there is obviously some risk involved. It is a bit of a blind pool where we're saying, hey, invest with us. We're not telling you which businesses we're buying in advance. You invest with us and you kind of have to hope that we make good decisions and so on. So there is some risk, sure. But like, I think it's a pretty compelling offer for investors for sure.
I agree. And again, it's not like a paid advertisement or anything. Again, I invested once last year or so and invested a couple of weeks ago myself. So, I'm kind of voting with my own wallet, which I think says kind of enough. And I think it's an interesting opportunity. And one of the reasons I invite you in here is I was, I've spent years either acquiring small businesses because I cannot afford kind of a large one, and then kind of spending a lot of time on just go to market and kind of product market fit and kind of alignment and like lacking the resource to just invest enough manpower to kind of build it. Or like S&P, which is fairly passive, and they've been some ups and downs, and it's really painful when you have a down because a down is a down, and sometimes a down is a year. And it's not really great when you have like 10% inflation and 10% down on your portfolio. It's just pains. Or traditional angel investing, which is, the vast majority of these don't pan out whatsoever. And you may be waiting 5, 6, 7 years for an exit, and they're not liquid at all. And there are some other kind of opportunities. You may find an opportunity to kind of put in by 5%, 10% off a business that's probably struggling, but it's just, it's harder. They're harder to find. Not everyone's just willing to sell a minority share. There's a lot of legal work involved in that. It is a painful process. So the opportunity to kind of co-own a part of an agency and kind of a portfolio of agency and kind of getting like 20+% return on average, at least that's kind of the forecast, and having the liquidity, I believe there's an opportunity to exit after year 2 or so, which of course you're not waiting for like 5, 6, 7, 8, 9 years or whatsoever. And you still own the agencies, and you can also utilize them. Like you can refer business, you can offload part of your business, or you can use them as a vendor as well to help them grow and also scale because you kind of have a partnership or so in some way, shape, or form. is just a pretty great opportunity. And I think that lots of people are just not aware of that opportunity in the first place. Like, I think it's a distribution problem than anything else. But yeah, so what are the terms to join again? Because I throw in some numbers that may have changed over time, but kind of starter ticket and kind of exit opportunities and stuff.
Yeah, I mean, at the moment, it's still 5K as the minimum investment. But I know people may be listening to this podcast sometime in the future. I don't know if that will be the case. I probably will increase the amount. The reason I made it 5K was because a lot of people said, well, I want to invest like 5K now just to get my feet wet and then come back with more later. So we've had some people invest 5K and then put in 20K later, or put in 75K later, and so on. So I may keep a low minimum, but really, if you're only going to invest 5K, it's probably not worth it. So, and then there's exit opportunities after. I think it starts after year 2. But again, if somebody's listening to this, it's year 2 from the start of the SPV. So if somebody's listening to this 6 months from now, then they don't have to wait as long. And that's pretty much it. But yeah, I think the best positioning for it in terms of someone trying to understand what type of investment it is, I would probably say it's a less risky angel investment. And I think the types of people investing in the SPV, they have similar characteristics to angel investors. They have a reasonable appetite for risk. They're able to do research and understand. Like if an angel investor doesn't understand the types of businesses that we're acquiring, they'll do the research, they'll understand, they'll look into Onfolio, they'll research me, stuff like that. And that's why I'm present on social media, because I want to make it easier for people to find me and understand my thinking and so on. But it's less risky because, like you said, an angel investment, it's you put your money in, maybe you never see it again, or maybe you have to wait 10 years or 7 years to find out if it's even going to be successful. Whereas cash flows from day one, because we're buying these cash flow positive businesses. And it is very similar to somebody could say, well, I'm just going to buy 10% of this agency or buy 5% of that agency and just do it myself. The challenge there is, well, now it's not a passive investment, it's an active investment for you because you have to find those targets. Like, sure, once you've invested, it's probably passive, but you have to find those targets. And then what happens if the agency owner decides they don't want to pay you? You've got to deal with all these things. Whereas with Onfolio, not only now can all the agencies that we acquire start working together because they're all part of the Onfolio family, and a lot of the founders stay on and get given Onfolio preferred shares and stock options and so on. But in addition to that, we're a publicly traded company. So it's like the creme de la creme of corporate governance. So, the companies we're acquiring are being audited, and we have GAAP financials, and, we're not gonna, those overheads don't necessarily they don't come into the SPV at all. But the people who are managing the SPV have that level of corporate governance. So I think it's that's kind of why I think it's better than trying to sort of do it yourself.
And to top it off, one of the reasons agencies exit in the first place, especially to some form of private equity, is primarily the fact that, well, you get better opportunities, better rates, you sell easier, have more trust, more reputability, more credibility. And it's just, the sales process is just easier because you have a stronger back. So yeah, people just shouldn't neglect that, especially when you're a Nasdaq listed company.
Yeah, definitely.
And you mentioned social, and we are going to kind of come to a close in kind of a couple of minutes. But what are the main social channels that you see that other angel investors or people interested in Onfolio are kind of using, that you're kind of doubling down on? Like, is LinkedIn social? LinkedIn, like Medex, podcasts, newsletters. Kind of what are some channels that you seem to be having more conversation?
I've always done well with podcasts, and I actually exhausted myself and didn't do any podcasts for 6 months or a year. So maybe I should do more. So thanks for having me. Meta, I don't really do anything in Meta, but maybe I should. I've been doing some YouTube. I'm still trying to find there's so many different things I can talk about. I'm still trying to find my niche on YouTube. Like, should I talk about angel investing? Should I talk about actually running an agency? Should I talk about just buying online business in general? I'm kind of testing stuff and seeing what's going to resonate with people. And then Twitter and LinkedIn are good for me, for sure. Twitter, I don't get much love from the algorithm these days. I've heard a lot of people don't. So I'm spending a little bit more time on LinkedIn. But yeah, like maybe I want to go on some angel investor podcasts, something like that. But yeah, this sometimes people ask me, why are you so present on social media? Shouldn't you be busy running, a public company? And yes, I am busy running a public company, but also I'm not running any of the companies that we own. I'm running the public company. And one of the things that you do with a public company is you use its credibility and visibility to benefit your business. So that might be bringing investors in, it might be bringing new shareholders in, it might be appealing to potential partners. A lot of people who come to me to sell their business, it's because they found me on social media. Or a lot of people who I make an offer to buy their business, they'll go and binge all my content. And luckily my content is quite good, so it resonates with them. So it's really just like, it's basically just biz dev, you know, but for like the actual public entity rather than for the actual company that we're running.
Yeah, that founder-led motion is definitely working out. I think that's why social is kind of so oversaturated and so harder to stand out, but it's almost impossible to be an active founder and not be active on social. But
That's
yeah,
true.
great conversation. I'd love to hold you a lot longer, but I know that as a busy founder, you also have a meeting that you're already late for. So I appreciate you staying a bit later to kind of wrap it up. Where can people learn more about the SPV in order to look into the deck and decide whether they
Yeah.
want to join?
Yeah, they can go to onfospv.com, so just onfospv.com, or if you're outside the US, it would be onfoliospv.com. Or you can email dom@onfolio.com, just ask me questions. We've done webinars on YouTube and stuff as well. So, but if you go to that website, that's the best place to start.
Excellent. Well, again, thanks again for the chat. That was a great conversation and really passionate about the upcoming dividends, the quarterly ones coming soon and some of the new acquisitions coming on board. So thanks again. If you like that episode, if you want to ask Don some questions and you're not on LinkedIn yet, just drop a comment in the YouTube channel. I'm going to make sure we're going to convey and send back to Don for some follow-ups. And yeah, if you like the show, hit subscribe or let me know who else you want to see here in the comments. Thanks, everyone. Enjoy your day and see you in the next episode.